2 a.m. Two men sit in a government building in Dublin. Outside, the city sleeps. Inside, they're about to make a decision that will haunt Ireland for a generation. In the next 6 hours, they will sign a piece of paper guaranteeing $440 billion in bank debts, more than twice their entire economy. They believe they're saving their country. They're wrong. This is the story of the night Ireland bet everything on its banks and lost. A story of panic, pressure, and a promise that would cost ordinary families $14,000 each. This is the night everything changed. Section 1. The Midnight Summons. The phone rings at 9:47 p.m. Brian Lenihan, Ireland's Minister for Finance, has been staring at the same spreadsheet for 3 hours. The numbers refuse to make sense. Or rather, they make too much sense. The kind of sense that keeps a man awake, that makes his coffee taste like ash, that turns the familiar walls of his office into the closing walls of a tomb. He answers. The voice on the other end belongs to David Drum, Chief Executive of Anglo-Irish Bank. Drum's voice carries the particular strain of a man who has run out of options and knows it. Anglo-Irish Bank, the institution that had fueled Ireland's property miracle, the bank that had grown from a small business lender into a $100 billion giant in less than a decade, is bleeding out. Minister, we won't open tomorrow. 6 words. The death sentence of an institution. But Lenihan understands immediately that this is not about one bank. If Anglo falls tonight, it takes the others with it. Allied Irish Banks, Bank of Ireland, the entire Irish financial system, the backbone of the Celtic Tiger economy that had transformed this small island nation into Europe's success story. All of it, gone before sunrise. Lenihan hangs up. He does not sit down. There is no time to sit down. In the Department of Finance building on Marion Street, the lights burn through the September darkness. The building itself is Georgian, elegant, built in an era when money moved slowly and crises took months to develop. Tonight, crisis moves at the speed of a phone call. Brian Cowan, the Taoiseach, arrives shortly after 10 p.m. He is a big man, broad-shouldered, with the weathered face of someone who grew up in the Midlands of Ireland, far from Dublin's financial district. He had been celebrating, or trying to celebrate, at a dinner event. Now his tie is loosened, his expression unreadable. Cowan has been Taoiseach for less than 5 months. He inherited an economy that everyone assured him was fundamentally sound. Tonight, he will learn exactly what that assurance was worth. The two Brians, Cowan and Lenihan, are joined by their senior advisors. Kevin Cardiff, a career civil servant who has spent his life in the intricate machinery of Irish public finance, spreads documents across the conference table. The Attorney General, Paul Gallagher, reviews the legal frameworks, or lack thereof, for what might need to happen. And in the corner, on speakerphone, the voices of the bankers themselves, executives from Anglo-Irish, AIB, Bank of Ireland. Their voices overlap, interrupt, plead. We need liquidity support. The ECB has cut us off. If we can't open tomorrow, there will be queues around every branch in the country by noon. You have to understand what that means. Queues around the branches. The phrase sounds almost quaint, something from a black and white photograph, the Great Depression, the bank runs of 1929. But the men in this room know that human nature has not changed. Panic is panic. When people believe their money is about to vanish, they do not wait for official announcements. They run, and when they run, they bring the system down with them. They must start. The clock passes 11 p.m. Kevin Cardiff has been running calculations that grow more horrifying by the hour. Anglo-Irish Bank's exposure to property development loans exceeds $70 billion. This is not investment in factories, in technology, in anything that produces ongoing value. This is concrete and glass, shopping centers and apartment blocks, hotels and office buildings, many of them still unfinished, standing like skeletons across the Irish landscape. The developers who borrowed this money are themselves leveraged to the breaking point. If Anglo calls in its loans, the developers collapse. If the developers collapse, the property market collapses. If the property market collapses, every other bank's loan book is revealed as worthless. The interconnection is total. There is no firebreak. There is no safe ground. But the problem extends beyond Anglo. Allied Irish Banks, the respectable institution that has been financing Irish business since 1966, carries its own property exposure. Bank of Ireland, the oldest bank in the country, founded in 1783, has its own vulnerabilities. Irish Life and Permanent, Irish Nationwide Building Society. Each one has been drinking from the same fountain, lending into the same bubble, assuming that property prices would never fall. Property prices have been falling for 18 months now. The men in this room watched it happen and assured each other it was a correction, a pause, a normal market adjustment. Now they understand it was a cliff, and they have already gone over the edge. The only question is how far they will fall. Midnight approaches. Brian Lenihan is not a banker. He is a barrister by training, a politician by profession. He has been finance minister for less than 4 months. In that time, he has discovered that the briefing books he was given upon taking office bore little resemblance to reality. The Irish economy was not a Celtic tiger. It was a house of cards built on borrowed money and foreign capital, and the wind has finally begun to blow. He knows what the bankers want. They want the government to step in, to use the full faith and credit of the Irish state to back their obligations. They want a guarantee. The word sits in the room like an unexploded bomb. A guarantee means that if the banks cannot pay their creditors, their bondholders, their depositors, their counterparties across Europe, the Irish government will pay instead. It means taking the liabilities of private institutions and placing them squarely on the shoulders of Irish taxpayers. It means that the risk created by bankers in glass towers will be absorbed by nurses in Cork, by teachers in Galway, by shopkeepers in Dublin who never bought a bank share in their lives. But the alternative is unthinkable, or at least, it is unthinkable in the hours between midnight and dawn, when every phone call brings worse news, when the European Central Bank has made clear it will not extend emergency support to failing Irish institutions, when the global financial system is itself in freefall. Lehman Brothers collapsed 2 weeks ago. The American government allowed it to fail, and the result has been chaos, a cascading failure of confidence that has frozen credit markets worldwide. Ireland is not America. Ireland does not have the Federal Reserve. Ireland does not have a currency it controls or a debt market that the world treats as sacred. Ireland is a small country on the western edge of Europe, and it is very, very exposed. At 12:30 a.m., the phone calls intensify. The executives of AIB and Bank of Ireland have been listening to the discussion about Anglo, and they have reached a conclusion. If the government saves Anglo alone, it marks their own institutions as unsafe. The market will assume, correctly as it turns out, that Anglo was saved because it was the weakest, and that the others must therefore be weak as well. The contagion will spread. They want in on any rescue. They want the same protection. They want the guarantee extended to cover everyone. Richard Burrows, the governor of Bank of Ireland, speaks directly to the Taoiseach. His institution is 225 years old. It has survived famines and revolutions, world wars and economic depressions. It has never faced a night like this. If you guarantee Anglo alone, we'll face a run by morning. Eugene Sheehy of AIB agrees. The banks, fierce competitors who would not share a water cooler under normal circumstances, have found sudden solidarity. They are all drowning in the same ocean. The advisors argue. Some favor a more limited intervention, perhaps nationalizing Anglo, ring-fencing its bad debts, letting the markets sort out the rest. Others argue that any partial measure will be seen as insufficient, that markets will test the Irish government's resolve and find it wanting. There is no playbook for this. There is no precedent. There is only the ticking clock and the knowledge that when Asian markets open in a few hours, when European trading begins, the world will be watching to see what Ireland does. Brian Cowan looks at Brian Lenihan. Two men, alone with a decision that will define their country for a generation. The night is still young. Section 2. The longest hours. Brian Cowan looks at Brian Lenihan. Two men, alone with a decision that will define their country for a generation. The night is still young. The conference room has become a pressure cooker. It is now 1:15 a.m. on September 30th, 2008. The ashtrays are full. Though smoking was banned in government buildings years ago, no one mentions it tonight. Coffee cups sit abandoned, their contents long since gone cold. The Georgian windows look out onto Marion Street, where the city sleeps in ignorance of what is unfolding inside these walls. Brian Lenihan has removed his jacket. His shirt sleeves are rolled to the elbow, and there are dark circles forming beneath his eyes. He has been finance minister for 122 days. In that time, he has learned that his predecessors left him a ticking bomb disguised as an economic miracle. The bankers are still on the line. David Drum of Anglo-Irish has been joined by the bank's chairman, Sean Fitzpatrick, a name that will become synonymous with Irish financial catastrophe. Though tonight, he is still regarded as a visionary, the man who built Anglo from nothing into Ireland's third largest bank. Fitzpatrick's voice carries the particular confidence of a man who has never been told no. We need certainty, Taoiseach. The markets need to know that Ireland stands behind its banks. Kevin Cardiff, the senior civil servant, slides another document across the table. It is a rough calculation of what a full guarantee might mean. The numbers are staggering. $440 billion in liabilities across the 6 guaranteed institutions. This is more than twice Ireland's entire GDP. It is, quite possibly, the largest bank guarantee in the history of the world relative to the size of the guaranteeing economy. Cowan stares at the figure. You can see him trying to process it, trying to square this number with everything he knows about public finance, about risk, about the fundamental relationship between a government and its people. We're guaranteeing everything? Deposits, senior debt, subordinated debt, covered bonds, all of it. Cardiff's voice is flat, factual. He is not making a recommendation. He is stating what the bankers are asking for. The Attorney General, Paul Gallagher, interjects. He has been reviewing the legal mechanics of how such a guarantee would work. Irish law does not contain a ready-made framework for this. They will have to improvise, drafting legislation in the hours before markets open, presenting it to the Dáil as an emergency measure. If we do this, Gallagher says carefully, we need to understand that we are assuming contingent liabilities that dwarf anything this state has ever undertaken. If the banks cannot meet their obligations, the state must. And if we don't do this? Cowan asks. The room falls silent. The silence stretches for what feels like minutes. Finally, one of the banking executives, it is later disputed exactly who, speaks the words that have been hanging in the air all night. If there's no guarantee, we won't open. And if we don't open, the ATMs stop working by Wednesday. The ATMs stop working. You have to pause on that phrase. You have to understand what it means for a modern economy. It means the pensioner in Limerick cannot withdraw money for groceries. It means the small business owner in Sligo cannot pay her employees. It means the hospital in Dublin cannot process payments for supplies. It means the entire circulatory system of the Irish economy, the movement of money from account to account, from buyer to seller, from employer to worker, simply stops. It means chaos. It means queues and panic and anger. It means the complete breakdown of the ordinary trust that allows a society to function. Brian Cowan has been in politics for over 20 years. He has seen crises before, economic downturns, political scandals, the long shadow of the Troubles. But he has never seen anything like this. He has never sat in a room at 2 a.m. and been told that the entire financial system of his country could collapse before the week is out. He looks at Lenihan. Lenihan looks back. There is an understanding between them. The wordless communication of two men who have been thrust into an impossible position. Neither of them created this crisis. Neither of them bears primary responsibility for the decades of loose lending, the property mania, the regulatory failures that allowed the banks to gorge themselves on debt. But they are here now, and the decision is theirs. What are our options? Cowan asks. The options, as presented by the civil servants and advisors, are brutally limited. Option 1. Do nothing. Let Anglo-Irish Bank fail. Let the dominoes fall where they may. The consequences would be immediate and catastrophic. Bank runs, a frozen payment system, the probable failure of the entire Irish banking sector within days. International confidence in Ireland would collapse. The country's ability to borrow on international markets would evaporate. Ireland would become the first Western European nation to experience a complete financial system failure since World War II. Option 2. Nationalize Anglo immediately. Take the bank into state ownership, guarantee its deposits, but allow its bondholders and creditors to take losses. This is the Swedish model, the approach that Sweden used in its early 1990s banking crisis, forcing private investors to share the pain of bank failures. But the Swedish crisis unfolded over months, not hours. There is no time to execute a proper nationalization, to conduct due diligence on Anglo's true condition, to set up the legal and operational frameworks required. And there is a deeper fear. The European Central Bank has signaled that it views bondholder losses as dangerous, potentially contagious, a threat to the wider European banking system. If Ireland imposes losses on Anglo's creditors, the ECB might cut off liquidity support to all Irish banks. The medicine could kill the patient. Option 3, the guarantee. Announced that the Irish state stands fully behind all obligations of the major Irish banks. Reassure depositors, bondholders, and counterparties that their money is safe. Buy time to assess the true state of the banks, time to arrange more permanent solutions, time to let the global financial crisis play out and perhaps improve. The guarantee is not a solution. Everyone in the room understands this. It is a tourniquet, applied in the desperate hope that the patient can be stabilized long enough for surgery. But at 2:30 a.m. on September 30th, 2008, with global markets in freefall and the Irish banking system hours from collapse, a tourniquet is all they have. Brian Lenihan steps out of the conference room. He walks down the corridor, past the portraits of former ministers who governed in simpler times. past the ornate ceilings and the polished floors that speak of an older Ireland, a poorer Ireland, an Ireland that could never have imagined $400 billion in bank liabilities. He needs air. He needs a moment to think. The night outside is cool and quiet. Marion Street is deserted. The streetlights cast pools of orange light on the pavement. Somewhere in the distance, a siren wails. A reminder that the city continues to function, that people are going about their lives, unaware that their government is about to make a decision that will shape their futures for decades. Lenihan is 49 years old. He comes from a political family. His father was a minister. His brother is a politician. Politics is in his blood, but nothing in his family history, nothing in his legal training, nothing in his experience as a backbench TD and junior minister has prepared him for this moment. He knows the risks of the guarantee. He knows that he is being asked to bet the entire fiscal capacity of the Irish state on the proposition that the banks are fundamentally sound, that their problems are liquidity problems rather than solvency problems, that time and confidence will allow them to recover. He suspects, though he cannot prove it, not tonight, not with the information available, that this proposition is false. He suspects that the banks are not merely illiquid, but insolvent, that their loan books are riddled with losses that have not yet been recognized, that the property market collapse will eventually reveal debts that no amount of government support can cover. But what choice does he have? He returns to the conference room. The clock reads 3 a.m. The drafting begins. Working from existing legislation and improvising where necessary, the legal team begins to assemble the credit institution's financial support bill. It is a remarkable document, given the circumstances of its creation, clear, comprehensive, sweeping in its scope. It authorizes the Minister for Finance to provide financial support to credit institutions, defined broadly enough to cover virtually any form of assistance the government might need to provide. The guarantee itself will be announced separately, as a government decision rather than a legislative act. This is a tactical choice. Legislation must go through the dial, must be debated and voted upon, must follow the ordinary procedures of Irish democracy. A guarantee announced as executive action takes effect immediately. Speed is everything now. At 4:00 a.m., the wording of the guarantee is finalized. It covers 6 institutions: Anglo-Irish Bank, Allied Irish Banks, Bank of Ireland, Irish Life and Permanent, Irish Nationwide Building Society, and the Educational Building Society. It covers deposits, senior debt, subordinated debt, and certain other liabilities. It runs for 2 years, until September 29, 2010. The total value of the guaranteed liabilities is $440 billion. This is roughly 2.5 times Ireland's annual GDP. It is, in proportional terms, the largest bank guarantee ever issued by any government in the history of the world. Brian Lenihan reads the final text. His signature will make it official. Outside, the first gray light of dawn is beginning to appear over Dublin. The city is stirring. Soon the morning news will begin. Soon the markets will open. Soon the world will learn what Ireland has done. Lenihan signs. Section 3. The morning after Brian Lenihan reads the final text, his signature will make it official. Outside, the first gray light of dawn is beginning to appear over Dublin. The city is stirring. Soon the morning news will begin. Soon the markets will open. Soon the world will learn what Ireland has done. Lenihan signs. The announcement goes out at 6:30 a.m. Government press officers, themselves exhausted after being summoned in the small hours, distribute the statement to newsrooms across Dublin. Radio producers scramble to rework their morning lineups. Television crews rush to set up outside government buildings. The machinery of Irish media, caught completely off guard, lurches into action. RTE's Morning Ireland breaks the news just after 7 a.m. The presenter's voice carries the particular cadence of someone reading words they do not fully understand. Words that will require economists and analysts and historians to unpack. The government has announced an unprecedented guarantee of the Irish banking system. All deposits and debts of 6 major financial institutions are now backed by the full faith and credit of the Irish state. In homes across Ireland, people pause over their breakfast. They hear the words guarantee and banking system and unprecedented. They do not yet know what these words will mean for their lives. They do not yet know that the decision made in the small hours of this September morning will shape their country for a generation. But they sense, perhaps, that something fundamental has changed. The trading floors come alive at 8 a.m. In the dealing rooms of Anglo-Irish Bank, of AIB, of Bank of Ireland, the screens flicker to life. Traders who went home the previous evening in despair, watching their stock prices crater, fielding panicked calls from clients, wondering if they would have jobs by the end of the week, now stare at their monitors in disbelief. The guarantee has worked, or at least it appears to have worked. Bank of Ireland's share price, which had collapsed 17% the previous day, opens higher. AIB stabilizes. Even Anglo-Irish, the institution at the heart of the crisis, sees its stock recover some of the ground it had lost. The immediate panic, the fear of bank runs, of ATMs going dark, of the complete collapse of the Irish financial system, begins to recede. In Frankfurt, the European Central Bank issues a cautiously supportive statement. The guarantee, while extraordinary, has preserved the integrity of the European banking system. Ireland has taken action to protect depositors and creditors. Contagion has been contained. In London, in New York, in the financial centers that drive the global economy, the reaction is more mixed. Some analysts praise Ireland's decisiveness. Others question whether a small nation can credibly guarantee $440 billion in bank liabilities. The smart money begins to calculate. What happens if those guarantees are called upon? What happens if the bank's losses exceed what Ireland can afford to pay? But those questions are for another day. Today, the immediate crisis has passed. Today, the banks will open. Today, the ATMs will continue to dispense cash. Brian Lenihan, who has not slept in over 24 hours, faces the press. The press conference is held in government buildings. Lenihan stands behind a podium, flanked by officials. His face shows the strain of the night, the shadows under his eyes, the slight pallor of exhaustion. But his voice is steady, his demeanor calm. He has been a barrister, trained to present arguments under pressure, to project confidence even when the ground beneath him is uncertain. The government has decided to guarantee all deposits and certain liabilities of the 6 major Irish credit institutions, he announces. This guarantee is designed to maintain financial stability and to protect depositors. It is in the interest of the Irish economy and the Irish people. Reporters' hands shoot up. Questions come in rapid succession. Minister, how can Ireland afford to guarantee $400 billion in liabilities? Lenihan's answer is careful, almost scripted. The guarantee is a contingent liability. It does not require the state to actually pay out these amounts. It is a statement of confidence in the Irish banking system. We believe the banks are fundamentally sound. Fundamentally sound. The phrase will come back to haunt him. It will be quoted and requoted as the scale of the bank's losses becomes apparent. It will be held up as evidence of either deliberate deception or catastrophic naivety. But on the morning of September 30th, 2008. Brian Lenihan believes, or at least hopes, that it is true. Another question. Why guarantee the bondholders? Why not let them take losses? This is the question that will define the Irish crisis. It is the question that European officials have quietly answered for Lenihan, behind closed doors, in conversations that will not be made public for years. The ECB does not want bondholder losses. The ECB fears that if Ireland imposes losses on bank creditors, it will trigger a panic across Europe, a run on Spanish banks, on Italian banks, on the entire interconnected web of European finance. Lenihan does not explain this. He cannot explain it, not without revealing the pressure that has been applied, the constraints under which Ireland is operating. The guarantee covers all liabilities, he says simply. This is what is required to maintain confidence. The Dáil convenes that afternoon. The chamber is packed. Every TD has been summoned for an emergency session. The government benches are tense, uncertain. The opposition benches are smelling blood. Enda Kenny, leader of Fine Gael, rises to demand answers. Eamon Gilmore of the Labour Party demands accountability. The smaller parties, the Greens, Sinn Féin, add their voices to the clamor. Brian Cowan faces the chamber. He is not a natural orator. His speaking style is blunt, sometimes awkward, lacking the rhetorical flourishes of his predecessors. But today, he speaks with a gravity that silences even his harshest critics. We faced a choice, Cowan tells the Dáil. We could allow our banking system to collapse, with catastrophic consequences for every family, every business, every community in this country. Or we could take action to protect the system and the people who depend on it. We chose to act. The opposition is skeptical but constrained. They cannot be seen to oppose a measure designed to protect ordinary depositors, to prevent bank runs, to save jobs. They ask hard questions about the size of the guarantee, about the risk to taxpayers, about the lack of consultation. But in the end, the credit institutions' financial support bill passes by an overwhelming margin. The vote is 124 to 18. Ireland's political system, for all its divisions, has united behind the guarantee. Whatever comes next, they will face it together. Donegal, that evening, Brian Lenihan returns to his office. The immediate crisis has passed. The banks are open. The markets have stabilized. The headlines, while alarming, are not catastrophic. Ireland, it seems, has pulled back from the brink. But Lenihan knows that this is not the end. It is barely the beginning. He has seen the loan books, or at least the summaries that the banks have provided. He knows that Anglo-Irish's exposure to property development is far larger than the public realizes. He knows that the collateral backing those loans, the half-built apartment complexes, the empty office parks, the shopping centers that will never see a customer, is worth a fraction of what the banks claim. He knows, though he cannot say it publicly, that the guarantee may not be enough. On his desk sits a report from the Department of Finance. It is an internal assessment, prepared hastily in the aftermath of the guarantee decision. The report attempts to estimate the likely losses in the Irish banking system under various scenarios. The best-case scenario suggests losses of $5 billion to $10 billion, painful but manageable. The worst-case scenario suggests losses of $50 billion or more. 50 billion euros. That is more than the entire Irish government budget. It is more than the country collects in taxes in a year. It is a number so large that it threatens not just the banks, but the state itself. Lenihan reads the report. He does not share it. Not tonight. Tomorrow there will be more meetings, more decisions, more crises to manage. Tomorrow, he will begin the long process of trying to understand what the banks actually own and what it is actually worth. Tomorrow, the real work begins. But tonight, for a few hours at least, Ireland is stable. The guarantee has held. The worst has been averted, or so it seems. Section 4. The reckoning begins. But tonight, for a few hours at least, Ireland is stable. The guarantee has held. The worst has been averted, or so it seems. 6 weeks pass. It is now mid-November 2008, and the leaves have fallen from the trees along Marion Square. The Georgian townhouses stand in their faded elegance, watching over a city that is slowly beginning to understand what has happened to it. The property market has not recovered. It has accelerated its collapse. In Ballsbridge, once the most exclusive address in Dublin, a development site that sold for $412 million in 2006 sits empty, its hoardings advertising luxury apartments that will never be built. In the Dublin Docklands, the glass towers of the International Financial Services Centre look out over construction cranes that have stopped moving, their operators laid off, their projects frozen mid-pour. In Cork and Galway and Limerick, the story is the same. Abandoned developments, shuttered estate agents, the sudden silence of an economy that had been roaring for a decade. The banks, meanwhile, are hemorrhaging. Brian Lenihan has been receiving weekly reports from the financial regulator, and each report is worse than the last. The loan losses are not $5 billion. They are not $10 billion. They are climbing toward figures that nobody in government had imagined possible. And then, in December, the first bomb explodes. Most of times, Sean Fitzpatrick's office at Anglo-Irish Bank is a monument to success. The corner office on St. Stephen's Green, with its views across Dublin's premier park, speaks of a man who has made it. Fitzpatrick, at 60 years old, has been the driving force behind Anglo's transformation from a minor player into Ireland's most aggressive lender. He is a regular on the business pages, a fixture at charity dinners, a man whose opinion is sought by politicians and journalists alike. On December 18, 2008, his world comes apart. The story breaks in the Irish Times. The newspaper has obtained documents showing that Fitzpatrick had been hiding personal loans from Anglo's own accounts. For years, 8 years, it will later emerge, he had been temporarily transferring his borrowings to another institution, Irish Nationwide Building Society, just before Anglo's year-end audit. Once the audit was complete, the loans would be transferred back. The maneuver was designed to conceal the fact that Anglo's chairman had borrowed tens of millions of euros from his own bank. The loans total $87 million. The sum is staggering. This is not a minor accounting irregularity. This is systematic deception, carried out by the chairman of a bank that the Irish government has just guaranteed to the tune of tens of billions of euros. This is fraud dressed in a business suit. Fitzpatrick resigns immediately. His statement is brief, lawyerly, carefully worded to avoid admissions. He expresses regret. He takes responsibility. He disappears from public view, retreating to his home in Greystones, while the storm rages around him. But the damage is done. The revelation about Fitzpatrick changes everything. In the Department of Finance, Brian Lenihan reads the news with a cold fury. He has spent the past 2 months defending the guarantee, defending the banks, assuring the Irish public and international markets that the institutions are fundamentally sound. Now he learns that the chairman of Anglo-Irish Bank, the bank at the center of the crisis, the bank whose potential failure triggered the guarantee in the first place, has been systematically deceiving regulators for nearly a decade. What else has been hidden? The question hangs over every subsequent meeting, every phone call, every report. If Fitzpatrick could conceal $87 million in personal loans, what other secrets lurk in Anglo's books? What other time bombs are ticking in the Irish banking system? Lenihan orders a comprehensive review. The financial regulator is instructed to conduct a deep examination of Anglo's loan portfolio. External auditors are brought in. The central bank assigns additional staff to monitoring the guaranteed institutions. But the process takes time. Due diligence on a $100 billion loan book cannot be completed in days or weeks. And while the examiners work their way through the files, the losses continue to mount. Christmas 2008 is a subdued affair in Ireland. The shops on Grafton Street are quieter than usual. The festive lights still hang across the streets, but they illuminate a city that has lost its confidence. Unemployment is rising, up 80% from the previous year, with 300,000 people now out of work. The construction industry, which had employed 1 in 8 Irish workers at the peak of the boom, is collapsing. Developers who were millionaires a year ago are now facing bankruptcy. In the pubs and living rooms of Ireland, the conversation turns to blame. Who did this? Who allowed it to happen? The bankers, certainly, Fitzpatrick and his ilk. The men who lent billions on the assumption that property prices would rise forever. The regulators, who failed to see the crisis coming despite warning signs that were visible to anyone who cared to look. The politicians, who encouraged the boom, who boasted about the Celtic tiger, who failed to build up reserves during the good times. But there is also a more uncomfortable truth, one that many Irish people are reluctant to face. The ordinary citizens who borrowed beyond their means, who bought properties they could not afford, who believed that rising prices would make them rich. The collective madness of a nation that convinced itself it had discovered the secret to perpetual prosperity. The hangover is just beginning. Anokako, January 2009, brings new horrors. Anglo-Irish Bank publishes its annual results. The numbers are catastrophic. The bank has made a loss of $4.3 billion for the year, the largest corporate loss in Irish history. But even this figure, shocking as it is, understates the true position. The auditors have been forced to make assumptions about the value of Anglo's property loans, assumptions based on a market that has essentially ceased to function. If property prices fall further, and everyone knows they will, the losses will be far greater. The government has no choice. Anglo must be nationalized. On January 15th, Brian Lenihan announces that the state is taking full ownership of Anglo-Irish Bank. The shareholders, whose investments have already been reduced to near zero, are wiped out entirely. The government injects $1.5 billion of capital into the bank, the first of what will become a seemingly endless series of bailouts. But nationalization does not solve the fundamental problem. It merely transfers that problem from private hands to public ones. The loans are still there. The losses are still mounting. The guarantee is still in place. And the guarantee, as the world is beginning to realize, may be far more expensive than anyone imagined. In Frankfurt, the European Central Bank is watching closely. Jean-Claude Trichet, the ECB's president, is a man of impeccable credentials and iron convictions. He believes in rules, in discipline, in the fundamental principles that have governed European monetary policy since the creation of the euro. He also believes that Ireland has made a commitment embodied in the guarantee, and that this commitment must be honored. The ECB has been providing liquidity support to Irish banks since the crisis began. Without this support, the billions of euros in short-term lending that allows the banks to meet their daily obligations, the entire system would collapse. But the support comes with strings attached. Strings that are not made public. Strings that will later become the subject of bitter controversy. One string, in particular, will prove crucial. The ECB does not want Ireland to impose losses on bank bondholders. The bondholders are institutional investors, pension funds, insurance companies, other banks, who hold the debt securities that Anglo and the other Irish banks issued during the boom years. Under normal circumstances, when a bank fails, these bondholders would take losses. That is the bargain of capitalism. Higher returns come with higher risks, and those who lend to failing institutions must accept the consequences. But these are not normal circumstances. The European financial system is interconnected in ways that the architects of the euro never fully anticipated. German banks hold Irish bank bonds. French banks hold Spanish bank bonds. Italian banks hold Greek bank bonds. If Ireland imposes losses on its bondholders, the contagion could spread, a wave of panic that could threaten banks across the continent. Trichet makes his position clear in private conversations with Irish officials. The guarantee must be honored. The bondholders must be paid. Ireland must not become the first domino. Brian Lenihan receives this message and understands its implications. He is caught between two impossible pressures. On one side, the Irish public, who are beginning to realize that the guarantee may cost them dearly, who are asking why ordinary taxpayers should bail out wealthy investors who made bad bets. On the other side, the ECB, which controls the liquidity that keeps the Irish banks alive, which has made clear that bondholder losses are unacceptable. In his office on Marion Street, Lenihan works through the numbers once again. Anglo's losses are now estimated at $15 billion and rising. The other banks, AIB, Bank of Ireland, have their own problems, their own property losses, their own need for capital. The total bill for the banking crisis could reach $50 billion. It could reach $70 billion. Nobody knows for certain. What Lenihan does know is that Ireland cannot afford this. The country's annual tax revenue is $33 billion. Even if every cent collected by the government were diverted to bank bailouts, it would not be enough. The state will have to borrow, and borrowing means debt. And debt means that future generations of Irish people will be paying for the mistakes of 2008 for decades to come. He picks up the phone and calls the Taoiseach. Brian, we have a problem. Section 5. The slow drowning. He picks up the phone and calls the Taoiseach. Brian, we have a problem. Spring arrives in Dublin, but no one notices the blossoms. It is April 2009, and the Department of Finance has become a war room. The elegant Georgian building on Marion Street, designed for an era of quill pens and ledger books, now hums with the energy of crisis management. Officials work through nights and weekends. The corridors smell of stale coffee and anxiety. The portraits of former ministers look down from the walls, their painted expressions offering no guidance for the catastrophe unfolding below. Brian Lenihan has a plan. Or rather, he has the outline of a plan. A desperate attempt to separate the good assets from the bad, to create some structure that can absorb the losses without destroying the state itself. The plan has a name: NAMA, the National Asset Management Agency. The concept is borrowed from Sweden, from the resolution trust corporations that cleaned up the American savings and loan crisis in the 1980s. The government will create a new entity, a bad bank, that will purchase the toxic property loans from the Irish banks at a discount. The banks will receive cash or government bonds in exchange for their worthless assets. Their balance sheets will be cleaned. They will be able to lend again, to support the real economy, to function as banks are supposed to function. In theory, it is elegant. In practice, it is a nightmare. The first question is the most important. What are the loans actually worth? This is not a simple accounting exercise. The loans are backed by property, land, buildings, development sites that no one wants to buy. The property market has not merely declined, it has ceased to exist. There are no transactions, no price discovery, no way to determine what anything is actually worth. The banks naturally argue that their assets are valuable. They insist that the property market will recover, that the loans are temporarily impaired, but not permanently worthless. They produce valuations that assume modest declines, optimistic recovery scenarios, a return to something like normal within a few years. The Department of Finance is skeptical. So is the European Commission, which must approve NAMA under state aid rules. So are the international investors who are watching Ireland's every move, calculating whether the country can actually afford to clean up its banks. The negotiations drag on for months. Each loan must be examined individually. Each property must be valued. Each developer must be assessed. The work is tedious, exhausting, and ultimately heartbreaking. A systematic cataloging of the wreckage left by the boom. By autumn 2009, the outlines of NAMA are clear. The agency will acquire $77 billion in loans from the banks. It will pay approximately $54 billion for these loans, a discount of 30%. The difference, the $23 billion that the banks will not receive, represents losses that must be absorbed. But $23 billion is only the beginning. The banks need capital. This is the fundamental problem that NAMA cannot solve. Even after their bad loans are transferred to the state, the banks remain desperately undercapitalized. The losses have eaten through their reserves, their shareholders' equity, their capacity to absorb further shocks. They need fresh money, billions of euros of fresh money, to meet regulatory requirements and continue operating. Where will this money come from? Not from private investors. No sane investor will put money into Irish banks while the property market continues to collapse, and the full extent of the losses remains unknown. The share prices of AIB and Bank of Ireland have fallen by more than 90% from their peaks. The market has rendered its verdict. These institutions are not worth saving with private capital, not from the European Central Bank. The ECB provides liquidity, short-term loans to meet daily obligations, but it does not provide capital. It does not invest in banks. It does not take equity stakes. The ECB is a lender of last resort, not an owner of first resort. The money must come from the Irish state, from the taxpayers who are already struggling with rising unemployment and falling incomes, from the government that is already running a massive budget deficit as tax revenues collapse and social welfare spending soars. Brian Lenihan announces the first round of recapitalization in February 2009. The state will inject $5 billion into AIB and $3.5 billion into Bank of Ireland. Anglo-Irish, already nationalized, will receive whatever it needs to stay alive. The numbers sound large. They are not large enough. The summer of 2009 brings a brief, cruel illusion of recovery. Global markets stabilize. The panic that followed Lehman's collapse begins to recede. Stock prices rise, credit markets thaw. In the United States, economists begin to talk about green shoots, early signs that the worst is over. Ireland allows itself a moment of hope. Perhaps the guarantee has worked. Perhaps NAMA will clean up the banks. Perhaps the country can grow its way out of the crisis, as it has grown its way out of troubles before. The hope does not survive the autumn. In September 2009, exactly 1 year after the guarantee, the government announces the results of a new stress test on the banking system. The tests are designed to determine how much capital the banks would need under adverse scenarios. Further property price declines, continued economic contraction, rising unemployment. The results are devastating. Anglo-Irish Bank alone needs an additional $4 billion in capital. This is on top of the $4 billion already injected. The total cost of saving Anglo, a single institution, a bank that should have been allowed to fail on that September night, is now approaching $10 billion, and the losses keep coming. Patrick Honohan arrives in Dublin in September 2009. The new governor of the Central Bank of Ireland is an academic economist, a professor at Trinity College Dublin who has spent his career studying financial crises in developing countries. He has written papers on banking failures in Africa, in Latin America, in the transition economies of Eastern Europe. Now he finds himself at the center of a crisis in his own country. Honohan is different from his predecessors. He is blunt where they were diplomatic. He is willing to deliver uncomfortable truths in plain language. He does not suffer fools, and he has concluded that the Irish financial system has been run by fools for far too long. His first act as governor is to commission a comprehensive investigation into the causes of the crisis. The report, when it is eventually published, will be scathing. A systematic indictment of the regulators, the bankers, and the political leaders who allowed the bubble to inflate and then did nothing as it burst. But that is for later. In the autumn of 2009, Honohan's immediate concern is survival. The banks are increasingly dependent on ECB funding as private creditors flee, as depositors withdraw their savings, as bondholders refuse to roll over their debts. The ECB has become the lender of last resort, the only source of liquidity keeping the Irish banks alive. The numbers are staggering. By the end of 2009, Irish banks owe the ECB more than $80 billion. This is not sustainable. Everyone knows it. The ECB knows it. The German government, which effectively underwrites the ECB, knows it. The Irish government knows it. Something will have to give. Christmas 2009 is grimmer than the year before. Unemployment has reached 12.5%, the highest rate in the European Union. Emigration has resumed for the first time in decades, with thousands of young Irish people leaving for Australia, for Canada, for anywhere that offers the hope of a job. The construction industry has shed 150,000 workers. Shops are closing on high streets across the country. Restaurants that were fully booked during the boom now struggle to fill a single table. The government responds with austerity. Brian Lenihan presents his third budget in December, and it is the harshest in the history of the state. Public sector wages are cut by up to 15%. Social welfare payments are reduced. Capital spending is slashed. The budget aims to close a deficit that has ballooned to 14% of GDP, the largest in the Eurozone. The cuts provoke fury. Trade unions organize mass protests. Public sector workers march on the Dale. There is talk of general strikes, of resistance, of a population that has been pushed too far. But the alternative is worse. Without the cuts, Ireland cannot borrow on international markets. Without borrowing, the government cannot pay its bills. Without paying its bills, the state itself will fail. Lenihan knows this. He takes no pleasure in the cuts. He understands the suffering they will cause. But he believes, he has to believe, that there is no other way. In his office late at night, after the votes have been counted and the budget has passed, he allows himself a moment of exhaustion. He is 50 years old. He has been fighting this crisis for 18 months. He has aged visibly, the stress carved into his face. He does not know it yet, but he is already ill. The pancreatic cancer that will kill him within 2 years is already growing inside him, undetected. He will spend the remaining time he has trying to save a country that may not be savable. Outside his window, Dublin sleeps. The lights of the city twinkle in the December darkness. Somewhere out there, families are struggling to pay their mortgages, wondering if they will have jobs next month, trying to explain to their children why Christmas will be smaller this year. The guarantee was supposed to protect them. Instead, it has bound their fate to the fate of the banks, and the banks are still falling. Section 6. The Black Hole. The guarantee was supposed to protect them. Instead, it has bound their fate to the fate of the banks, and the banks are still falling. The new decade begins with a number that defies comprehension. On March 30th, 2010, 18 months after the fateful guarantee, Brian Lenihan rises in the Dáil to announce the latest estimate of Anglo-Irish Bank's losses. The chamber falls silent. Even the opposition benches, usually eager to heckle, sense that something extraordinary is about to be revealed. The total capital requirement for Anglo-Irish Bank, Lenihan says, his voice steady despite the weight of the words, is now estimated at $22 billion. 22 billion euros for a single bank, a bank that should have been allowed to fail, a bank whose collapse was prevented by a guarantee that was supposed to cost taxpayers nothing. The figure represents approximately $5,000 for every man, woman, and child in Ireland. It is more than the entire annual budget for the health service. It is more than Ireland spends on education in 3 years. It is a number so large that it has ceased to have meaning. It is simply a void, a black hole into which the nation's wealth is disappearing. And it is not the final figure. Everyone in the chamber knows this. The property market is still falling. The loans are still deteriorating. The true cost of Anglo-Irish Bank will not be known for years. The opposition explodes. Enda Kenny, leader of Fine Gael, is on his feet before Lenihan has finished speaking. His face is flushed with genuine anger. The anger of a man who voted for the guarantee in good faith and now realizes the scale of the deception. The Irish people were told that this guarantee would cost nothing. Kenny thunders. They were told the banks were fundamentally sound. They were told that a liquidity crisis would pass. Minister, you have led this country into a disaster of historic proportions. Lenihan does not flinch. He has faced these accusations for months. He has defended decisions made in the small hours of September 30th, 2008. Decisions made with incomplete information under impossible time pressure. He believes, he has to believe, that the alternative would have been worse. The decision to guarantee the banks was taken to prevent a catastrophic collapse of the financial system, he responds. Had we not acted, every bank in this country would have failed within days. The consequences for ordinary depositors, for businesses, for the entire economy would have been devastating. And the consequences now, Kenny demands. Are they not devastating? 22 billion euros for a single bank? How much more, Minister? How much more will the Irish people be asked to pay? Lenihan has no answer. No one does. The weeks that follow bring a grim procession of revelations. Anglo's loan book, now being systematically examined by NAMA and the financial regulator, is a catalogue of recklessness. Billions of euros were lent to a small circle of property developers, men with grandiose visions and insufficient capital, who borrowed against assets that existed only on paper. The names become familiar through endless newspaper coverage. Sean Quinn, the once richest man in Ireland, who bet his fortune on Anglo shares and lost everything. Liam Carroll, the reclusive developer whose empire of companies collapsed like dominoes. Bernard McNamara, Derek Quinlan, Jerry Gannon, a roll call of the boom years, now synonymous with catastrophe. The loans were not merely large, they were concentrated. Anglo's top 10 borrowers accounted for more than $16 billion in exposure. The bank had bet its entire existence on a handful of men and their property schemes. When the market turned, there was no diversification to fall back on, no cushion to absorb the losses, and the lending practices were worse than anyone had imagined. Internal documents reveal that Anglo's credit committees routinely approved loans without adequate documentation. Valuations were inflated, sometimes by developers' own surveyors. Repayment capacity was assumed rather than demonstrated. The bank operated less like a financial institution and more like a casino, with depositors' money as the chips. The financial regulator, it emerges, knew about many of these practices. Warnings were raised internally, memos were written, nothing was done. The culture of light-touch regulation, the belief that markets knew best, that banks could be trusted to manage their own risks, had rotted the system from within. Summer 2010 brings no relief. The Irish economy is contracting for the third consecutive year. GDP has fallen by more than 10% since the peak, a collapse comparable to the Great Depression. Emigration is accelerating. 65,000 people left Ireland in the year to April 2010, the highest number since the 1980s. The young, the educated, the ambitious, exactly the people Ireland needs to rebuild, are fleeing for opportunities elsewhere. The property market continues its death spiral. House prices in Dublin are now down 40% from their peak and still falling. Commercial property is even worse, down 60% in some areas. The collateral backing the bank's loans is evaporating, and with it, any hope that the losses might be smaller than feared. Brian Lenihan, meanwhile, is fighting on multiple fronts. At home, he faces a public that has lost patience with bailouts, with austerity, with politicians who promised that the worst was over and were wrong. The government's poll numbers have collapsed to historic lows. Fianna Fáil, the party that has dominated Irish politics for generations, is heading toward electoral annihilation. In Europe, Lenihan faces pressure of a different kind. The ECB is growing increasingly nervous about its exposure to Irish banks. The $80 billion in emergency lending has climbed to $90 billion, then $100 billion. Frankfurt wants reassurance that this money will be repaid. Frankfurt wants to know that Ireland has a plan, and in the bond markets, the wolves are circling. The bond market is a cold, efficient machine for measuring confidence. When investors believe a country can repay its debts, they lend at low interest rates. When they doubt, the rates rise. The spread, the difference between what Ireland pays to borrow and what Germany pays, is the market's verdict on Irish solvency. In the summer of 2010, the spread begins to widen. It starts slowly, almost imperceptibly. Irish 10-year bonds, which traded at spreads of 1% over German bunds before the crisis, creep up to 2%, then 3%. Each basis point represents millions of euros in additional borrowing costs. Each uptick is a vote of no confidence from the investors who ultimately decide whether Ireland can finance its debt. The trigger is Greece. In May 2010, Greece became the first Eurozone country to require a formal bailout, a $110 billion rescue package from the EU and the IMF, accompanied by savage austerity measures. The Greek crisis has focused international attention on the peripheral economies of Europe, on the countries with high debts and weak banking systems, on the dominoes that might fall next. Portugal is vulnerable. Spain is vulnerable. And Ireland. Ireland, with its guaranteed banks, its property collapse, its mounting fiscal deficit, is very vulnerable indeed. The bond markets begin to ask a simple question. Can Ireland actually afford its banking guarantee. Autumn arrives, and the pressure becomes unbearable. The Irish spread over German bunds reaches 4% in September. It reaches 5% in October. By the first week of November, it is approaching 6%, a level that makes it increasingly difficult for Ireland to borrow at all. The arithmetic is brutal. Ireland needs to raise approximately $20 billion per year to finance its deficit and roll over maturing debts. At 6% interest rates, the cost of servicing this debt consumes an ever larger share of government revenue. The higher the rates go, the more Ireland must borrow to pay interest on existing borrowing. It is a death spiral, a vicious circle that can end only in default or rescue. Brian Lenihan knows the game is nearly up. He has spent the past weeks in intense negotiations with the European Commission, the ECB, and the IMF, the Troika, that will come to dominate Irish economic policy for years to come. The discussions are secret, conducted behind closed doors, away from the markets and the media. But the outlines are clear. Ireland will need a bailout. The only questions are when, how large, and on what terms. On November 18, 2010, Patrick Honohan decides to force the issue. The governor of the central bank is in Frankfurt for a meeting of European central bankers. It is early morning in Ireland when he goes on RTA's Morning Ireland program via phone. The interviewer expects the usual central banker boilerplate, measured language, careful hedging, nothing that might move markets. What she gets instead is the most consequential radio interview in Irish economic history. I think it's pretty clear that we're going to need a very substantial loan, Honohan says, his voice calm but unmistakably clear. A large loan. I'm talking about a loan perhaps of tens of billions. The words land like a thunderbolt. Honohan has done what no Irish official has been willing to do. He has admitted publicly that Ireland cannot save itself. He has acknowledged that the guarantee, the bailouts, the austerity, all of it has been insufficient. He has announced, in effect, that Ireland is surrendering its economic sovereignty to international institutions. The reaction is immediate. Irish bond yields spike. The euro falls. Television crews rush to government buildings, where ministers scramble to respond to a development they had not authorized and did not expect. Brian Lenihan is furious. He had been planning to manage the bailout announcement carefully, to negotiate final terms before going public, to control the narrative. Honohan has taken that control away. The governor, in Lenihan's view, has panicked the markets and weakened Ireland's negotiating position. But Honohan believes he has done the right thing. The pretense had become unsustainable. The markets knew. The European authorities knew. Only the Irish public was being kept in the dark. It is time, he believes, for honesty. The Troika arrives in Dublin on November 21st, 2010. They come with laptops and spreadsheets, with models and projections, with the accumulated expertise of institutions that have overseen dozens of financial rescues in countries around the world. They set up in the Department of Finance, taking over conference rooms and commandeering civil servants. They are polite, professional, and utterly in control. Ireland's fate is no longer in Irish hands. The negotiations last 10 days. The final package, announced on November 28th, totals $85 billion, $67.5 billion in external support from the EU and IMF, plus $17.5 billion from Ireland's own reserves and pension funds. In exchange, Ireland commits to a program of fiscal adjustment that will reduce the deficit to 3% of GDP by 2015. The banks will be recapitalized once more, a final injection intended to draw a line under the crisis. The interest rate on the loans is 5.8%. This is punitive, designed less to help Ireland recover than to discourage other countries from seeking similar rescues. Ireland, the EU has decided, must be made an example. Brian Lenihan signs the Memorandum of Understanding. He has no choice. Outside government buildings, protesters gather in the rain. They carry signs denouncing the banks, the government, the EU, the whole rotten system that has brought them to this point. Their anger is palpable, their sense of betrayal absolute. The guarantee that was supposed to protect Ireland has instead enslaved it. Section 7. The Long Road Back. Previous section text. Outside government buildings, protesters gather in the rain. They carry signs denouncing the banks, the government, the EU, the whole rotten system that has brought them to this point. Their anger is palpable, their sense of betrayal absolute. The guarantee that was supposed to protect Ireland has instead enslaved it. The winter of 2010 is the coldest Ireland has experienced in decades. Snow blankets Dublin in early December, turning the city into a frozen tableau. Buses cannot run, schools close, the homeless shelters overflow. It is as if nature itself has decided to mirror the national mood. A deep freeze settling over a country that has lost its way. Brian Lenihan watches the snow fall from his office window. He has just returned from the hospital, where doctors have confirmed what he suspected for months. The fatigue, the weight loss, the persistent pain in his abdomen. It is pancreatic cancer, stage 4, inoperable. He has perhaps a year to live. He tells no one outside his family. There is work to be done. The budget must be passed, the harshest budget in Irish history, implementing the first year of the Troika program. Public sector wages cut again, social welfare reduced again, new taxes on income, on property, on everything that moves. The measures will extract $6 billion from an economy already on its knees. Lenihan presents the budget on December 7th. He speaks for over an hour, his voice steady despite the poison growing inside him. He knows this will be his last budget. He knows too that it will define his legacy, a legacy of pain and sacrifice imposed on a people who did not deserve their fate. This budget is necessary, he tells the Dial. It is fair. It is the path back to sustainability and growth. I know the sacrifices I am asking the Irish people to make. I do not ask them lightly. The opposition jeers. The public galleries are packed with protesters. Outside, despite the snow, thousands have gathered to express their fury. But the budget passes. It always passes. There is no alternative. The political reckoning comes in February 2011. The Green Party, Fianna Fáil's coalition partner, has finally had enough. They withdraw from government, forcing an early election. Brian Cowan, battered by 2 years of crisis management, announces he will not lead Fianna Fáil into the campaign. The party chooses Micheál Martin, the foreign minister, as its new leader, a fresh face to carry the burden of accumulated failure. It is not enough. The election of February 25th, 2011, is a massacre. Fianna Fáil, which has governed Ireland for 61 of the past 79 years, is reduced to 20 seats, down from 77. It is the worst defeat in the party's history, a repudiation so complete that it will take a decade to recover. Candidates who held their seats for 30 years are swept away. Ministers who shaped Irish policy for a generation are rejected by their constituents. Brian Lenihan holds his seat in Dublin West, one of the few Fianna Fáil survivors. But he is a diminished figure now. Gaunt from the cancer treatment, a man fighting 2 battles he cannot win. Fine Gael and Labour form a new government. Enda Kenny, who spent years in opposition railing against the guarantee and the bailout, becomes Taoiseach, He inherits a country in receivership, its economic policy dictated by the Troika, its sovereignty mortgaged for a generation. The new government promises change, but the constraints are absolute. The bailout agreement is a binding contract. The debts must be paid. The banks must be saved. The bondholders must be made whole. There will be no renegotiation. There will be no burning of bondholders. There will be only austerity, stretching into an indefinite future. Brian Lenihan dies on June 10, 2011. He is 52 years old. He has served as Minister for Finance for 3 years that encompass the greatest economic catastrophe in Irish history. He made decisions that will be debated for generations. The guarantee, the bailouts, the austerity budgets that followed. He made them under impossible pressure, with incomplete information, in the face of forces beyond any individual's control. The tributes cross party lines. Enda Kenny, who spent years attacking Lenihan's policies, speaks of his dedication, his intellect, and his courage. Michael Noonan, the new finance minister, calls him a patriot who gave everything for his country. Even those who believe his decisions were catastrophically wrong acknowledge his personal integrity, his willingness to take responsibility, his refusal to abandon his post even as his body failed. The funeral mass is held at the Church of the Sacred Heart in Donnybrook. The president attends. Former Taoiseach fill the pews. Outside, ordinary citizens gather to pay respects to a man who became, in his final years, the face of Ireland's suffering. Brian Lenihan is buried in Glasnevin Cemetery, near the graves of Irish revolutionaries and statesmen. The inscription on his headstone is simple. His name, his dates, his service to the state. The crisis he tried to contain continues without him. The years that follow are years of grinding endurance. The Troika reviews arrive every quarter. Teams of officials from the EU, the ECB, and the IMF descending on Dublin to examine Ireland's books, to verify compliance with the bailout terms, to demand further cuts if targets are missed. The reviews become a national ritual, a humiliation that serves as constant reminder of how far Ireland has fallen. Emigration accelerates. By 2013, the net outflow reaches 89,000 people per year, the highest rate since the Great Famine of the 1840s. A generation of young Irish people scatters across the globe, to Sydney and Melbourne, to Toronto and Vancouver, to London and New York. They leave behind parents who wonder if they will ever return, communities hollowed out by departure, a country that seems to offer no future. The property market continues to fall. House prices in Dublin drop 56% from peak to trough. Negative equity traps hundreds of thousands of homeowners. People who owe more on their mortgages than their properties are worth. Who cannot sell, who cannot move, who are chained to debts they will spend decades repaying. The banks, despite the bailouts, remain zombies. They do not lend. They cannot lend. They are consumed by the task of managing their bad loans, of working out their property exposures, of slowly recognizing losses that they spent years pretending did not exist. And the final bill for the banking crisis keeps growing. Anglo-Irish Bank, renamed the Irish Bank Resolution Corporation in a futile attempt at rebranding, requires additional capital injections. By the time it is finally wound down in 2013, the total cost to the Irish state exceeds $30 billion. Allied Irish Banks costs another $21 billion. Bank of Ireland, the least damaged of the major institutions, still requires $5.3 billion. Irish Nationwide Building Society adds $5.4 billion more. The total cost of the banking bailout reaches $64 billion, approximately $14,000 for every person in Ireland. This is money that will not be spent on hospitals or schools, on roads or railways, on the infrastructure that might help the country recover. This is money extracted from the Irish people to pay debts incurred by bankers who faced no personal consequences for their failures. But Ireland endures. Ireland survives, and eventually Ireland recovers. The turning point comes gradually, then suddenly. The economy stabilizes in 2012. Growth returns in 2013. By 2014, Ireland is the fastest growing economy in Europe, a remarkable turnaround driven by exports, by foreign investment, by the same multinational corporations that have made Ireland their European base for decades. In December 2013, Ireland becomes the first Eurozone country to exit its bailout program. The Troika departs. The quarterly reviews end. Economic sovereignty, such as it is, returns to Irish hands. The recovery is real, but it is also incomplete. The wounds of the crisis do not heal quickly. The emigrants do not all return. The generation that came of age during the crash carries scars that will last a lifetime. Delayed careers, postponed families, a deep skepticism toward institutions that failed them. And the debt remains. The $64 billion spent on the banks has been added to the national debt, which climbs from 25% of GDP before the crisis to over 120% at its peak. Ireland will spend decades paying interest on money borrowed to save institutions that should have been allowed to fail. Every budget for a generation will be constrained by the choices made on that September night in 2008. The trials come slowly, anticlimactically. Sean Fitzpatrick, the former chairman of Anglo-Irish Bank, is eventually charged with fraud. The trial drags on for years, complicated by legal technicalities and procedural challenges. In 2017, nearly a decade after the guarantee, the case collapses due to irregularities in how evidence was gathered. Fitzpatrick walks free, never convicted of any crime. David Drum, the CEO who made that desperate phone call on September 29, 2008, flees to the United States. He spends years fighting extradition, living in Massachusetts while Irish prosecutors seek his return. He is eventually brought back, tried, and convicted of fraud in 2018. He serves less than 4 years in prison. The other bankers, the developers, the regulators who enabled them, most face no legal consequences at all. The crisis was systemic, diffuse, the product of collective failure rather than individual criminality. There is no single villain to punish, no cathartic moment of justice. The Irish people, who paid the price, are left with only questions. A decade later, in September 2018, the anniversary of the guarantee passes with little fanfare. The newspapers publish retrospectives. Economists debate whether the decision was right or wrong. The survivors of those years, the politicians, the civil servants, the bankers, offer their own accounts, their own justifications, their own regrets. Brian Cowen has retreated from public life, rarely speaking about the crisis he presided over. When he does speak, he defends the guarantee as the only option available under the circumstances, the decision that prevented a complete collapse. Patrick Honohan, now retired from the central bank, is more critical. In his memoirs and public statements, he questions whether the guarantee should have covered bondholders, whether the ECB's pressure was justified, whether Ireland might have negotiated a better deal. The truth is that no one knows. No one can know. The counterfactual. What would have happened if Ireland had let its banks fail, if it had burned the bondholders, if it had refused the bailout, exists only in imagination. Perhaps the collapse would have been total, catastrophic, a descent into chaos that makes the actual outcome look merciful. Perhaps the markets would have adjusted, the European authorities would have blinked, and Ireland would have emerged stronger for having stood its ground. History does not offer controlled experiments. There is only what happened. After what happened is this. On the night of September 29, 2008, two men made a decision that would define their country for a generation. They were not villains. They were not heroes. They were public servants facing an impossible choice, armed with incomplete information, surrounded by advisors who did not fully understand what was happening, pressured by forces beyond their control. They chose to guarantee the banks. They chose to protect the bondholders. They chose to place the full faith and credit of the Irish state behind institutions that had failed catastrophically in their fundamental purpose. The cost of that choice was borne by the Irish people, by the workers who lost their jobs, by the families who lost their homes, by the immigrants who lost their country, by the generation that lost its future. The cost was measured in billions of euros, in years of austerity, in a national trauma that reshaped Irish politics and society. And yet, Ireland survived. The country that was brought to its knees by the guarantee found a way to stand again. The economy that was destroyed by the property bubble rebuilt itself around different industries, different strengths. The people who were scattered by immigration maintained their connections, their identity, their hope for return. The guarantee was a mistake, or it was a necessity, or it was both. A necessary mistake, a catastrophic success, a decision that saved Ireland from immediate collapse only to condemn it to years of suffering. History will judge. The people who lived through it already have. In Glasnevin Cemetery, Brian Lenihan lies in the earth. The snow falls on his grave in winter. The sun warms it in summer. The seasons turn and Ireland moves on. But the night of the guarantee is never forgotten. It is the night Ireland learned what it truly cost to save the banks. It is the night that changed everything. And nothing has been quite the same since. And that's the story of how one night reshaped an entire nation. The guarantee didn't save Ireland. It bound the fate of every Irish citizen to banks that had already failed. It turned a banking crisis into a national tragedy. But Ireland survived. Scarred, changed, but still standing. If this story moved you, hit subscribe and turn on notifications. Every week, we uncover the hidden moments that shaped our world. Drop a comment below. Do you think the guarantee was the right call? Thank you for watching. Until next time, stay curious, stay informed.